So what are the Greeks and how do you use them to read options? In this video, I'm going to walk you through the basics and more in depth of how Greeks work and affect the price of an option. Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. So if you're new here, consider subscribing. And today we're talking about option Greeks. So what are the Greeks? The Greeks are variables that help determine how a price of an option changes based on a few different parameters. Now, the first one, and really one of the major ones, is delta. And what delta is it determines how the option price changes based on the underlying stock changing. So for every dollar that the stock goes up or down, delta tells you how much the option goes up or down. So for an example, usually delta is between 0 and 100, and 100 delta would mean that if the stock went up $1, the call would go up $100, and if it went down $1, the call would go down $100. And then for a 0 delta, well, that option would generally be worth nothing and it wouldn't change at all. And usually this is in points. So for here, a 70 delta means that the option value will change $70 based on a move. So with an at the money call being a 50 delta, as you go further and further out of the money, the delta decreases and the options move less and less with each dollar change in the stock. And then on the flip side of that, as you go further and further into the money, the delta increases and eventually gets to 1. So essentially, if you had a call, it would be just like owning 100 shares because your delta would be 100. And so you would get that exact dollar change per dollar move in the stock. So just understanding that a in the money call or a higher delta call will change a higher dollar value as the stock moves, and an out of the money call will change a less dollar value. But also keep in mind that a out of the money call is generally cheaper than an in the money call. And so here we have an options chain of Apple right now, and this column on the left here is delta. And so with Apple currently trading at about 175, this 175 call right here with the strike price being over here, this is a 50 delta, with a 50 delta being essentially at the money. And then as you go further and further out of the money or higher and higher in price or strike prices, the delta decreases. So you can see this next strike down is 35 and then 21. So it decreases pretty rapidly. And then also the option price or the cost of the option decreases as well. So out of the money options have a lower delta. So their value changes slower as the stock moves, but they're also cheaper. And then in the money, you can see here, this purple background area is in the money, and they are much more expensive. And you can see right now it's flipping back and forth just because we are right on that 175 level. So this purple at the money, in the money, out of the money will be switching in real time here. But you can see that as you go further and further into the money, the delta increases, and then also the price of the option increases really rapidly. And so eventually you can see here, once you get about above 85 or 90 delta, it costs you a lot more to buy this option and you're not getting much return per investment. So with this $90 delta call here being $1,000, and then this 97 delta call or right here being $2,000, or even this one up here being another 500, they're only moving another $7 per every dollar move in the stock, but having to invest almost more than double to get that extra $7. So keep in mind that sometimes the risk versus reward isn't necessarily there. And so generally that kind of sweet point can be more in this range, the 70 to 80 delta or even 65 delta. The options are still expensive, of course, but they're not insanely expensive as these further and further in the money options are. Down here, you're still getting a really good move. You're still getting 80 essentially for this $600 call compared to this 97 or 95 for a $2,000 call. So keep that in mind when you're looking at delta. So here's just another different visual way of looking at this. So if if we were going to buy an at the money call, right, that 175 where the stock is currently trading at, that would be a $50 delta call. And so this graph here is showing delta. So this number here is delta on the screen as it moves up. And then the price at the bottom is the price of the stock. So right now at 175, we have a 50 delta call. And if the stock moved up to 180, our delta would move all the way up to $80. So as the stock moves, the delta of our call also changes. Once we buy this call, it's not a 50 delta all the time. So if we go up $1, we gain $50. But if we go up another dollar, it might change. So if you see here, from 175 to 176, our delta moves up about 8. That increases as we go up. And as the stock goes up, our call will make more and more money for every dollar that the stock goes up. And you can see on the flip side, if the stock starts going down, we will be losing less and less as the stock goes down. So if it goes down $2 from here, we will be losing more of like $40 per every dollar it goes down. And so delta is dynamically changing at all times just based on where the current trading value of the stock is. So just because you buy a 50 delta call or a 70 delta call, it doesn't mean it's going to be 70 delta tomorrow or even maybe in the next 5 minutes. It will always be changing. And that change is actually called gamma. And so gamma is just the ratio at how much delta changes for every $1 move in the stock. So gamma is that change we were just talking about. So as the stock goes up and your delta goes up, gamma is why your delta increases or decreases. So as a quick example, if you had an option that had a delta of 3 and the stock went up $1, your delta or your 70 delta call would go to a 73 delta call. And so here we have a new column of gamma as well with our delta from before. And you can see that gamma is highest with at the money, or essentially where at the money is. So the options that are closest to the current trading value, their delta will be changing faster and faster, or their delta will be changing the most. And this decreases as you go further away from at the money in both directions. So to give you a little better visual of this, if we go to this profile again, and so this is the delta, if we put it to gamma, here we can see that the gamma is highest with at the money again, and as you go further and further out, the gamma decreases in both directions. And so this is why if we quickly flip back to the delta, because the gamma is decreasing as you get further out, that is why this delta graph kind of tapers off, and why you don't want to be buying those really far in the money options or really even super far out of the money options. It's why you kind of want to stick a little bit closer to at the money, is because the movement you will get will be a lot quicker because you have that gamma that will change your delta from maybe a 50 delta to a 60 delta pretty quickly, compared to further into the money, it will go from an 80 delta with a $2 move to an 89 delta or something. So that is how gamma works, and that is how it affects delta. Even though maybe you're trading options and buying and selling them before they expire, their true value does come from expiration. And so the closer and closer you get to that expiration, the closer they will be to realizing their true value. As an extreme example, if you have an option that has 300 days to expire, well, anything could happen in those 300 days. So the price of the option isn't going to change as quickly based on a change in the stock price, because who knows what could happen 300 days. If the stock skyrockets, it could just as easily come back down in that long of a time period. So the options price isn't going to as quickly show a huge move like that. But compared to an option that, let's say, going to expire tomorrow, the option is going to really show that a huge move, let's say 10%, because, well, this option is going to expire tomorrow. And so a 10% move is unlikely going to really pull back a huge amount in a short time period like that. And so our option is going to reflect that price change a lot more realistically because it is so close to expiration. And so wrapping that back into gamma, gamma increases as you get closer and closer to option expiration. And so a good way to show this is the gamma right now. This graph here is the gamma of the current day. And so if I bought this option right now, this is what the gamma will be. Now we can add a line here is what the gamma will be like in a week. And so I believe this option has, if I quickly go back here, this option has 2 weeks. And so right now, the day I'm filming this video is a Friday, and so the options would expire today. And so this will be a week out from its expiration instead of currently right now being 2 weeks out. And so down here in the bottom left, you can see the date, and you can see that the gamma spikes, or the gamma is a lot higher on the next Friday from now that's closer to expiration. But you can also see that it tapers off here as well, because again, it is honing in on that more real price, that if the stock is above 175, this option will have value, and if it is below, it'll be worthless, compared to there being a lot wider of a range when you have an option with a lot of time on it. Now to go into the actual day of expiration, that is when gamma really accelerates, because even a week out, a lot can happen, but the day of or a couple days ahead, that is when gamma really starts to get exponential. And you can see that by me showing this the last day of expiration. The gamma just dwarfs the gamma of other times. With seen on the bottom left down here, you can see the numbers. The gamma of the at the money is $25. And so on that last day, if you have a call of 50 delta and the stock moves up $1, you now have a 75 delta call. This just shows you how quickly that delta can change as you get closer and closer to the day of expiration. And so this can be really beneficial for you, but it can also be really detrimental. If you have, let's say, a position that's up $200 and you want to cash out at $210 and you're trying to just get that little extra bit left, well, with a $1 move on the last day of expiration, your option could lose a ton of value compared to normally. And so it can sometimes be better to close out positions sooner than later when it comes to getting close to expiration, because you don't want the stock to have a chance to move a tiny bit against you, because you will feel that tiny movement a lot more than you would feel it maybe 2 weeks out. Now, the next one on our list is theta. And what theta is, it's essentially how much value your option loses over time. And the number that it gives is how much your option loses every day. So if an option has a theta of negative 0.07, that means your option is losing $7 every day. When you're buying options, your theta will always be negative, but if you're selling options, your theta is positive. And so that is definitely a draw to selling options sometimes, is that time is on your side when you're selling options. And when you're buying options, theta is usually against you, or time is not on your side, and you're trying to have a stock move quickly so you don't have to have theta eat away at your profits. Now, just like gamma though, theta does increase as you get closer and closer to your option's expiration, because the main goal of your option is to reach its actual expiration value. There will be that premium on the option that needs to decay, and it will slowly decay over time, but the majority of it will decay as you get closer and closer to expiration at an exponential rate. So if we go back in TOS and look at the options chain and look at what theta looks like compared to delta and the price of an option, just like gamma, theta is the highest with at the money options, because that is generally where the most premium is for an option's value. And then as you go further away in both directions, the theta decreases. But one thing to keep in mind is the theta for, let's say, a $90 call that costs $1,000. $5 on $1,000 a day is really minimal compared to, let's say, $5 right here on a 20 delta call on $60. So this out of the money option is losing close to 10% a day because of theta. And so this is why out of the money options are really hard to become profitable, because they're decaying at such a rapid rate that your stock has to move almost instantly for you to stay break even and begin to make a profit. Now, of course, if a stock moves a ton, out of the money options can make bank, but quite often stocks don't do that. And so it is really important to keep in mind that if you do want to buy out of the money options, you need to be really sure that your position is going to work out in your favor quickly. And if it isn't, to be cutting that or closing that position quickly, because the theta is going to eat you alive. Now with these in the money options, of course, you're still losing $5 a day, but compared to how much money you're making per every dollar move, the option only has to go up, let's say $1 for you to make $90. And that gives you a lot more time in terms of theta eating away at your profits and the dollars or the stock going up, making you money. So it's a lot easier to become profitable and stay break even with an in the money option. Now, if we go to our chart again to look at more of what theta looks like on a graph, here you can see that again, just like we had, theta is highest with at the money, or lowest, sorry, because theta when you're buying an option will always be negative because theta is working against you. It's a negative number. If you're selling options though, this would be a positive number. So if we were selling this call here, this theta would be positive and it would just be a mirror image just flipped. And as we go further out of the money in both directions, our theta gets more and more closer to a positive number, and so it doesn't eat away at us as much. But just like gamma as well, this is exponential as we get closer and closer to expiration. So if we look at what our theta will be like in a week, you can see again that it kind of starts to peak up here. It goes from $8 at the money to $11. And then if we jump ahead to the Friday of expiration, again, you can see that it becomes a lot greater. And so this is one reason why it is important to buy options with more time than you may think, because even if you maybe need just like 3 days for your position to move, you would much rather be having the theta of a 2-week out option compared to a theta of a day of expiration or a few days of expiration. On the bottom left of the chart there, on that last day, the theta is -26. Now that is a lot more than a -8 or even a -11. So buying, let's say if you thought the stock was going to move over the next few days, it'd be a lot more beneficial for you to buy an option with, let's say, 2 weeks out instead of a week out. Because again, as you get closer and closer to expiration, the theta gets worse and worse. Now, the last one we'll talk about here is Vega. And what Vega is, it's essentially how much the option value changes based on implied volatility. Now, I will have a video on implied volatility and more diving into that, but essentially implied volatility is how much volatility the market is expecting to see over the option's lifetime. So if the market overall is really volatile and let's say there's a lot of fear in the market, maybe there's some huge news coming up like an election or something, that can cause the implied volatility to increase because people are expecting something to happen that is going to make the market to move very quickly in one or two directions. And so this affects the price of options. And so as implied volatility goes up, usually the options price increases. And then as it goes down, the options value will decrease with that. And so when you're buying an option, implied volatility is good for you because as implied volatility goes up, you will make money as that volatility goes up. And then with the opposite for selling options, Vega will be negative for you. And so if volatility goes up, as the option seller, you actually don't like that. Quickly looking at this on a options chain, the Vega is highest with at the money. And so going to our risk profile of that, again, you can see that as we go further into the money and further out of the money, the Vega decreases. And with this buying a call here, our Vega is $14. So that means for every 1% that implied volatility goes up, our option will go up $14. And so that can be pretty significant if the implied volatility of something is going up a lot, but it can also be really detrimental if the implied volatility suddenly vanishes. And so this is a huge reason why buying calls or buying options to hold through earnings is a really big losing strategy in a lot of ways. Because as companies release their earnings, the implied volatility the day before their earnings report is really high because Who knows what a company is going to say? They might say they're doing amazing. They might say they're doing horrible. And so the market has to expect that there's going to be volatility the next day. And so the implied volatility will skyrocket into that earnings. And then the next day when that earnings releases, the implied volatility will always plummet. No matter where the stock goes, your option will lose a ton of value, and maybe even 50% just based on implied volatility. And so because of that, even if you bought a call and the stock went up in your favor, you still might have a very hard time becoming profitable, even if your option is in the money, just because the fact that you paid so much for that option based on the implied volatility. So be careful when it comes to buying and selling options and holding through a company's earnings. Now, one interesting thing about Vega is, unlike Gamma and Theta, and even Delta a little bit, as you get closer and closer to expiration, if I just put both the days on here right now to get right to expiration, you will see that Vega decreases. And so this 14 is the Vega right now. And then as you get closer and closer to expiration, Vega actually gets smaller and smaller. And that is just because that, well, the option has less of a lifetime, and so that gives the stock less time to move in a certain direction. And so the change in implied volatility won't affect it as much because, well, it's unlikely that that move will actually happen in this option's lifespan. Now, all this analysis was for buying a call, and buying and selling basic options will generally be pretty similar. But when you're buying or selling more complicated strategies like verticals or spreads or iron condors, these will be a lot more different. And so I will be doing some analysis on those kind of strategies. And so feel free to subscribe to the channel if you want to look at those videos in the future. And if you have any questions, don't hesitate to ask them in the comments below.